inside the Bank of the People's shocking money laundering scandal. What if I told you that one of Europe's most trusted banks was just slapped with a massive $5 million fine? Their crime? Essentially helping criminals launder millions through their accounts for years. And this wasn't some oversight or technical glitch. It was a pattern of deliberate neglect. The Bank of the People, the Netherlands' fourth largest financial institution, just received one of the harshest anti-money laundering penalties in the country's history. But this story goes deeper than one bank's failure. What you're about to discover isn't just an isolated scandal, one that could be putting your money at risk right now. Let's pull back the curtain and expose what really happened at the Bank of the People and why it matters to everyone who trusts a bank with their money. The $5 million banking felony. To understand how bad this really was, we need to look at what the Bank of the People actually did, or more accurately, what they failed to do from July 2020 through April 2023. For 3 straight years, this bank with over 3 million customers systematically violated anti-money laundering laws in 11 separate customer cases. But these weren't simple mistakes or oversights. Every modern bank uses sophisticated software to flag suspicious transactions, unusual deposits, unexpected international transfers, large cash withdrawals. The Bank of the People had this technology too. It was working perfectly, identifying thousands of suspicious activities. The problem? Nobody was actually investigating these alerts. Let me show you the 3 most shocking cases that investigators uncovered. First, a miner's account received nearly $1 million in just 12 months. The bank's monitoring system should have immediately flagged this as suspicious. Children rarely have legitimate business reasons to receive this kind of money. But because the Bank of the People treated youth accounts exactly like adult accounts in their monitoring system, these massive deposits raised no red flags. Not a single investigation was launched. Not a single question was asked about where this money came from or why it was going to a child. The second case is just as troubling. A customer was withdrawing over $100,000 annually in cash, one of the biggest warning signs in modern banking. Large cash withdrawals are high risk because cash is untraceable and often used in criminal activities. When investigators asked about this customer, the bank admitted they'd accepted a ridiculous explanation, that the customer didn't trust banks anymore. Think about the logic here. Someone doesn't trust banks, but keeps hundreds of thousands in a bank account and makes regular withdrawals. This explanation should have triggered more scrutiny, not ended the investigation. But the third case reveals the systematic nature of the problem. The Bank of the People's monitoring system had a backlog of over 5,000 suspicious transaction alerts, with 533 high-risk cases sitting uninvestigated for more than a year. This wasn't a temporary staffing issue or a one-time technical glitch. For years, their system was correctly identifying thousands of potentially criminal transactions, and management was making the deliberate choice not to allocate resources to investigate them. Here's what makes this truly shocking. The Dutch Central Bank had already warned them about these exact issues 6 times between 2013 and 2021. They'd issued formal warnings, demanded improvements, and even imposed previous penalties. So the real question isn't how this happened, it's why. Why would a major financial institution repeatedly ignore direct regulatory commands and risk massive fines? The disturbing answer is simple economics. Proper anti-money laundering compliance is expensive. It requires specialized staff, sophisticated technology, and thorough investigation processes. More importantly, it creates friction in the customer experience. Extra questions, occasional delays, more documentation. Many banks have calculated that the occasional fine is simply cheaper than implementing proper controls that might slow down profitable activities. It's a cold business decision that puts all of us at risk. But on January 22nd, 2025, the Bank of the People's Gamble finally caught up with them, and the consequences went far beyond just a $5 million fine. When the Dutch central bank finally dropped the hammer on January 22nd, they didn't just issue a fine, they launched a financial reputation bomb. In an extraordinary move, regulators published comprehensive details of the bank's failures, ensuring that every customer, investor, and competitor could see exactly how they had compromised financial security. This wasn't just a financial penalty, it was a public execution of the bank's credibility. In an industry built entirely on trust, the Bank of the People now faces something far more expensive than $5 million of the permanent stain of being known as the bank that couldn't be bothered to stop criminals. But the consequences are still unfolding in 3 devastating waves that will cost them far more than the original fine. First, criminal investigations have been launched into specific transactions that slipped through their broken system. The bank now faces the nightmare scenario of having to admit exactly which suspicious transfers they ignored and which potential criminals they failed to report. Second, class action lawsuits are forming as customers discover their bank knowingly operated a compromised system that put their money and financial data at risk. The potential liability here makes the $5 million fine look like pocket change. Third, and most damaging in the long run, is the regulatory microscope now permanently fixed on their operations. Every decision, every transaction, and every process will face intense scrutiny for years to come, creating compliance costs and operational restrictions that will hamstring their competitiveness long after the fine is paid. What makes this case particularly stunning is the contrast between the bank's public image and private actions. While marketing themselves as secure and trustworthy, the Bank of the People was ignoring the very systems designed to make those promises true. This wasn't an isolated failure or a technical oversight. It was a systematic choice, repeated over years, despite explicit warnings. And that revelation leads us to the most important question. What critical warning signs should every bank and every banking customer recognize before they find themselves in the same position? Lessons learned. The 3 epic failures. What the Bank of the People created wasn't just a compliance failure. It was the perfect environment for financial criminals to operate undetected. The most shocking revelation isn't what they did wrong. It's how their failures created a predictable pattern that can be found in banks worldwide. The investigation exposed 3 fundamental flaws that transformed their anti-money laundering system from a security shield into a paper tiger. Understanding these flaws is crucial, not just for banks, but for anyone who trusts a financial institution with their money. The first fatal flaw: they built detection systems without investigation capacity. Imagine installing an expensive home security system that correctly detects break-ins, but nobody ever responds to the alerts. They invested in sophisticated alert technology that correctly identified thousands of suspicious activities, and then left those alerts sitting uninvestigated for months or years. Their monitoring system was generating on average 47 high-risk alerts per day, but they only had capacity to investigate about 20. The math simply didn't work. Every day, their backlog grew larger ensuring that potential criminals had plenty of time to complete their transactions and disappear before anyone at the bank would notice. The second fatal flaw: they created a dangerous risk classification imbalance. By labeling 95% of their customers as normal risk and rarely updating these classifications even when suspicious patterns emerged, they created a mathematical impossibility. There's simply no way that 95% of any bank's customers present identical risk profiles. But this classification system served a purpose. It justified minimal scrutiny for the vast majority of accounts, allowing the bank to allocate fewer resources to monitoring. Even more concerning, when suspicious activities were detected, the Bank of the People rarely updated the customer's risk classification. This created a self-reinforcing cycle. Classify customers as low risk, allocate fewer monitoring resources, miss the evidence that would require upgrading risk classifications. The third fatal flaw: they responded to warnings with temporary fixes rather than structural change. Despite 6 separate regulatory interventions over 8 years, the fundamental problems persisted. Each time regulators identified problems, the bank would implement just enough changes to satisfy immediate demands, without addressing the underlying causes. It's like patching holes in a dam while ignoring the structural cracks getting worse with each passing day. At the heart of this problem was organizational priority. Money laundering prevention was treated as a regulatory burden, a box to check, rather than a core responsibility. The compliance department was isolated, understaffed, and lacked the authority to implement real changes. The most unsettling insight from this case is how it exposes the fundamental tension at the heart of banking. Security measures cost money and create friction, while growth demands speed and convenience. The Bank of the People's repeated decision to underinvest in compliance reveals an uncomfortable truth. Many banks calculate that the risk of occasional fines is simply a cost of doing business, cheaper than implementing proper controls that might slow down profitable activities. This calculation affects every bank customer. When you deposit money at an institution that views security as a burdensome cost center rather than a core responsibility, you're unknowingly betting that their risk calculations won't eventually blow up and affect your finances. So, what can be done to prevent these failures? 3 critical changes could transform how banks approach anti-money laundering compliance. First, implement mandatory response deadlines for alerts with escalation protocols. No alert about potential money laundering should ever wait more than 30 days for review, and high-risk alerts should be addressed within 48 hours. Second, focus on quality over quantity in monitoring. Banks need fewer, more targeted monitoring scenarios that focus on high-impact risks, with adequate resources to investigate each alert properly. Better to have 10 well-designed alerts that always get investigated than 100 that pile up unattended. Third, and most powerful, is accountability. Banks that tie executive compensation directly to compliance outcomes see dramatically better results. When bonuses and careers depend on proper security implementation, resources miraculously become available. But what about you? How can you tell if your bank might be cutting the same dangerous corners as the Bank of the People? That was it for this episode. Hope you liked the content. Hit subscribe, tap that notification bell, and leave a comment below telling us which financial crime case you want us to break down next. Because remember, in the world of financial crime, what you don't know can hurt you. Stay safe, stay informed, and we'll see you in the next video.